the math and the science behind diversification, why it's a good strategy, is very clear. There's not much debate about that. The problem is people don't understand what diversification means. They think if they have 50 stocks in 10 sectors, semiconductors, consumer non-durables, or whatever, they're diversified. And what I say to them is, you may have 50 stocks, but that's one asset class. You're in stocks.
And this is the Conference Board top 10 leading economic indicators. And this particular data series has a 100% correlation with, if it declines, that means we're entering into recession, which will see stocks fall by as much as 30 to 50%. What do you think is a rational allocation right now for somebody who's at first and foremost trying not to get destroyed this year?
The first thing you say, diversification, the math and the science behind diversification, why it's a good strategy, is very clear. There's not much debate about that. The problem is people don't understand what diversification means. They think if they have 50 stocks in 10 sectors, semiconductors, consumer non-durables, or whatever, they're diversified. And what I say to them is, you may have 50 stocks, but that's one asset class. You're in stocks. And in stressful situations, they become highly correlated. So you're not getting the benefit of diversification. You think you are, but you're not.
We talked there about sort of diversification, largely with the eye towards sort of making it through what's coming here. Are there any areas that you potentially think are like, hey, given the events that we see coming, yes, while they're a little scary, there's some opportunity maybe to really, if you have some speculative capital, this could be a place that you think could pop really well.
But you got to pick the sectors and the stocks that will perform well, even in the kind of conditions we're talking about. And I would go back to energy, natural resources, agriculture. So, a Marathon, ExxonMobil, Chevron, ADM, Cargill, mining companies, and not just gold, yeah, but I recently invested in a lithium mine. I think, yeah, I mean, I like private equity, and it's, you got accredited investor issues and finding good deals and good promoters and good management. But, there's some good deals in the mining sector I like. Well, that would be one. I mean, we haven't.
Do you have any particular thoughts on silver versus gold right now in your 2023 outlook?
Yeah, I like them both. And, I talk about gold a lot because it's a form of money, and I do the monetary analysis. I do invest in gold mines, but I don't hold myself out as a geologist, but I do think about it from a monetary perspective. And then people always say, Jim, what about silver? What about silver? Like, look, if gold soars the way I expect, silver's along for the ride. There's not going to be a world of $3,000 gold and $20 silver. That world doesn't exist. If gold's at 3,000, silver's going to be pushing 100. So without giving an exact forecast, silver will be along for the ride. Silver is a little more difficult to analyze because it has industrial applications. Gold really doesn't. Gold's not good for anything except money, but it's the best form of money. Silver is used in a lot of applications. So if you have a recession, it's perhaps the case that the monetary value is going up, but the industrial input value is going down. So it's a little bit more of a mixed bag, but silver is going to do fine. And I do think it's extremely practical because in a world of CBDCs, silver will be a form of spending money. Gold, even the 8-gram coin I mentioned, the quarter ounce American Gold Eagle, still $500. It's like pulling a $500 bill out of your wallet. It's a lot for groceries.
Right. So think of the gold more sort of the store of value, and silver more as the currency.
Yeah, but the quarter ounce, maybe 10 of them gets you a new car.
A number of analysts and investors, on this program recently, who have echoed what you just said there about bonds, and there are three really good reasons to hold them right now. One is just safety, right? This is a time to prioritize safety. Two, they're paying a lot more than they used to pay, so you're getting paid to sit in safety, which is nice. But then they have that option value, right? Where if the Fed does pivot and rates come down, yields come down, the actual underlying price of the bond would go up, and so. A number of these guys have said, that bonds, particularly the sovereign bonds, especially the U.S. Treasuries, they're looking the best they've seen in a long while. And relatively recently, some have said it's like the best I've seen in my career. So I'm just curious, do you find that compelling for the moment in time we're in here?
Absolutely. There's hate to get too deep in the weeds in terms of bond math, but there's something called a DV01. DV01 is the dollar value of 1 basis point. What that means is, obviously, basic bond math, interest rates come down, the value, the price of the bond goes up. They're just invert. It's a little counterintuitive, but rates come down, the bond goes up. The question is how much? And the lower the interest rate, the more the price of the bond goes up for every basis point drop in rates. So in other words, if you go from 9% to 8%, you'll have a nice capital gain on your bond. But if you go from 3% to 2%, it's still a 1% drop, but you're going to have a much bigger capital gain. In each instance, it's a 1% drop in rates, but the amount of capital gain on the bond is much higher. As the DV01 is higher when the rates are lower. Again, it's all counterintuitive.
But it's sort of like a Richter scale. Each new increment is a much higher magnitude.
The lower the rate, the greater the capital gain on each basis point drop in yields. That's the basically. So yeah, when you go from 3% to 2%, that's a home run in terms of capital gains. So you get the yield, you get the safety, you get the liquidity, and if you feel like selling it, you get a nice fat capital gain.
Jim was talking about the three storytellers, right? The Fed, the markets, and reality. And if we just keep looking at, reality as best we can define it, which is looking at all of our data series, the vast preponderance of the macro data series just look terrible. They look bad and they're worsening. So clearly the markets are ignoring that right now. And even the Fed is trying to, get out there and get the markets to become a little bit more, a little bit less enthusiastic. As we've said before, the financial conditions are looser today than they were when the Fed began its campaign of rate hikes and QT back in March of last year. So that's exactly not what the Fed wants to have happen here, right? So it's going to be very interesting to learn whatever Jerome Powell and the Fed announced in the next 15 minutes or so. But I will say it's going to be hard for me not to see them trying to take as tough a stance as possible, because the animal spirits of the market are right now just completely ignoring what the central planners are trying to guide them to. And part of me is sort of, rooting for the Fed here, that they're bringing some much needed sobriety to the situation here. But part of me also has a ton of schadenfreude, because this is a monster these guys created. I'm like, yeah, of course it's hard to get under control. You've been training this market for practically 15 years, that you're always going to step in and save it.
Yeah, he talked, getting to really, the point about, well, how do you allocate assets today in this market in light of what we've just touched upon? And, he talked about the buzzword of diversification. Our industry has professed the benefits and the virtues of diversification for decades. And the reality is that most folks misunderstand what diversification is and what it means. And our industry itself does, because a standard portfolio in our industry is diversified if it has, hundreds of stocks or thousands of stocks and 20 different bond funds, but you're still in basically two broad asset classes, stocks and bonds. And when things, especially in a monetary policy-induced bubble like we've had over the last, growing over the last decade, where manipulated interest rates lower have caused all assets, including bonds and stocks, to rise to unnatural levels. The diversification benefits of those two broad asset classes no longer are helpful because they become highly correlated in major sell-offs. Most in any kind of recent shocks we've seen, you've seen broad asset classes of stocks and bonds sell off and together.